Hello friend, and good to have you here and welcome to my channel once again. In today's video, we'll be talking about the pillars for financial success. This applies to you irrespective of where you're watching this video from in the world, but especially for those in North America. And when I say North America, I'm talking about those in the United States of America and Canada. You will find this video a wonderful resource. Now, as every building starts with a foundation, so also our financial empire usually stands on the foundation, and that foundation starts with protection. We will see as we go along in this video series that the protection layer is made up of so many components. Now, without wasting much of your time, let's dive into it and I'll see you in the next video. Hello and welcome back to today's video, where we'll be discussing the financial independence number regarding financial planning. Now, the financial independence number is a term that's used to describe the point at which your investment income will cover your living expenses, which will allow you to retire or pursue other life goals without having to work for a living. In other words, this is when you have enough saved and invested so you don't have to rely on a traditional job for financial support. Now, in order to determine what your financial independent number is, you'll need to consider several factors, such as your current living expenses, your desired lifestyle in retirement, and the inflation rate. You also need to determine the amount of passive income you will need to cover these expenses. To calculate this financial independent number, you simply multiply your annual living expenses by 25. That's the general rule of thumb. Now, this is based on a rule of thumb that if you should have saved 25 times of your annual living expenses to be financially independent by age 65. Deal with practical numbers. Take for example, if your annual living expense is $50,000, then your financial independent number will be $1.25 million. That's $50,000 times 25. It's important to keep in mind that this is just a rough estimate and may not apply to everyone. Some people may need more or less depending on their individual circumstances. In Canada, for example, there are several options for savings and investing to help you reach your financial independent number. Some of these options include the use of RRSPs, that is the Registered Retirement Savings Plan, the TFSAs, that's the Tax-Free Savings Account, the pension, and the non-registered investment account. For each option, it has its own benefits and drawbacks. So it's important for you to do your research and understand the difference between all these options before you end up making a decision. It is also important to seek professional advice from a financial advisor to help you determine the best strategy for reaching your own financial independence number. They can help you create a personalized financial plan that takes into account your specific goals, risk tolerance, investment time horizon, and other conditions that they see fit. Now, in conclusion, calculating your financial independent number is a critical step in achieving your financial freedom. By understanding how much you need to save and invest, you can make informed decisions that take the necessary steps to reach your financial goals. Thank you for watching, and I hope this video has been helpful in teaching you one or two things regarding your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hi everyone, and welcome back to our channel where we discuss everything financial planning. In this segment, we're going to be talking about something very important, something that is the very foundation of your financial planning journey, and that is the financial need assessment. Now, what exactly is the financial need assessment, you may ask? Simply put, it is a process of evaluating your current financial situation and goals and your objectives in order to identify the resources that you need to achieve those goals and to meet your needs over the long term. When you meet with a financial advisor for the very first time, one of the very first things that they will do is to conduct a financial need assessment. Now, this is done in order to get a better understanding of your current financial situation, including your income, your expenses, your assets, your debt, and your insurance coverage. This assessment will also help you and your financial advisor identify any potential gaps in your current financial planning and help you determine the strategies and resources that you need to close those gaps and ultimately reach your financial goals. For example, if you're saving for retirement, your financial advisor may help you determine how much you need to save each month to reach your goals and what type of investment account or vehicles that are best suited for your needs. Another key aspect of the financial need assessment is the risk management side of it. Your financial advisor will also help you assess your risk tolerance and determine the right mix of insurance coverage, such as the life insurance, disability insurance, and the critical illness insurance to help you protect your family and your assets in the event of an unexpected event. The bottom line is this: financial need assessment is an important first step in your financial planning journey, and it will give you the peace of mind that you're on the right track towards reaching your goals and securing your financial future. So what exactly are you waiting for? If you haven't done so already, schedule a meeting with your financial advisor today and start your journey towards financial peace of mind. Thank you for watching, and I hope this video has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hello everyone, and welcome back. In this segment, we're going to talk about critical illness and disability insurance as an integral component in financial planning. We'll explore why having this insurance are important and how they work, and what to consider when choosing the right coverage for you. Why is critical illness and disability insurance important, you may ask? Critical illness and disability insurance act as a safety net that provides financial support in case you become seriously ill or unable to work due to an injury or disability. These types of focus on recovering without worrying about money. Now, how do they work? Critical illness pays you a lump sum of money if you are diagnosed with one of the covered illnesses, such as cancer, heart attack, or stroke. This money can be used to pay for medical treatment, modify your home to accommodate your needs, or to pay your bills. Disability insurance provides you with a monthly benefit if you're unable to work due to injury or illness. This type of insurance helps you cover living expenses such as mortgage payments, groceries, and other bills. What to consider when choosing coverage? Number 1, the benefit and coverage amount. You want to choose the policy that provides the right amount of coverage for your needs. Consider how much money you will need to cover your expenses in case of illness or disability. The second thing to consider is a waiting period. Some insurance policies have a waiting period before you can start receiving this benefit. Make sure you understand the waiting period and choose a policy that meets your need. The third thing to consider is the coverage options. Consider the different coverage options available, such as critical illness only, disability only, or a combination of both. Choose the policy that provides the best coverage for your specific situation. Now, the fourth thing to consider is the cost. The cost of insurance is an important factor to consider. Make sure you can afford the premium and that the coverage is worth the cost. Now, in conclusion, critical illness and disability insurance are important components of a proper financial plan. They provide financial support during a difficult time and can help you focus on recovering without worrying about money. When choosing a policy, consider the benefits and coverage amount, the waiting period, the coverage options, and of course, the cost. Thank you for watching, and I hope this video has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hello and welcome to this video about last will and testament and the power of attorney for financial planning. In this video, we will be discussing the importance of having a will and the power of attorney and how it can help you plan for your financial future. What is a last will and testament? A last will and testament is a legal document that outlines how you would like your assets and possessions to be distributed after your death. It is a crucial document for anyone who wants to ensure that their last wishes are followed and that their loved ones are taken care of. In Canada, for example, a will must be in writing, signed by you and 2 witnesses who are over the age of 18. Now, what is a power of attorney? A power of attorney for financial planning is a legal document that gives someone else the power to make decisions on your behalf if you are unable to do so. This person is known as your attorney, and they will have the authority to make decisions about your finances, your investments, and your property. This is particularly important if you become incapacitated and can no longer make decisions for yourself. Effective financial planning is a critical aspect of preparing for the future. It ensures that you have enough money to meet your needs and that your assets are distributed according to your wishes. A last will and testament and the power of attorney are essential tools as they provide peace of mind, knowing that your financial affairs will be handled properly if something should happen to you. Now, what are the benefits of having a will and power of attorney? You may ask. Having a will and power of attorney in place can provide several benefits, including number 1, simplifying the probate process for your estate. Number 2, protecting your assets. Number 3, reducing the stress and burden on your loved ones. Number 4, ensuring that your wishes are followed. Number 5, providing peace of mind, knowing that your financial affairs will be handled properly if something happens to you. In conclusion, a last will and testament and power of attorney for financial planning are essential tools for anyone who wants to plan for their financial future. It is important to take the time to review and update these documents regularly to ensure that your wishes are followed and that your loved ones are taken care of. Thank you for watching, and I hope this video has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hello and welcome back. In this section of today's video, we will be talking about debt management as it relates to financial planning. Now, debt is a fact of life for many of us, but it doesn't have to be a source of stress or financial burden. With a little bit of planning and discipline, anyone can take control of their debt and turn it into a positive aspect of their financial life. Now, first, let's talk about what kind of debt is considered a good debt and what kind of debt is considered a bad debt. A good kind of debt is a debt that will eventually benefit you, such as a student loan or a mortgage on a home. A bad debt, on the other hand, is a debt that you can't afford to pay back and that doesn't help you build wealth, such as a credit card debt. The next important thing is to understand the different types of debt that you may currently be facing. The credit card debt, the personal loans, the student loans, and mortgage debt are all common types of debt in a country like Canada. Understanding the different types of debt and how they work is the first step in managing them effectively. Once you've assessed your debt, time to start paying it off. The first step is to prioritize this debt by their interest rate, so you can focus on paying off the debt with the highest interest rate first. This will help you save money in the long run, as the interest on your debt will be less. In addition to paying off your debt, it's important to focus on building good financial habits. This includes living within your means. Yes, you heard me right. Living within your means. It's not about borrowing money to please those that don't even care about you. You need to learn to stick to a budget and avoid taking on more debt than you can handle. Another important aspect of debt management is to communicate with your creditors. If you're struggling to make payment, take out time and reach out to your creditors to discuss your options. They will be willing to work with you to create a payment plan that fits your budget. Finally, consider seeking the help of a financial advisor. They can help you create a debt management plan and provide you with the tools and resources to help you achieve your financial goals. Managing debt is an important aspect of your financial planning. With a little bit of planning, discipline, and good financial habits, anyone can take control of their debt and turn it into a positive aspect of their financial life. Thank you for watching, and I hope this video in particular has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hello and welcome to today's video on leveraging as a tool for financial planning. Leveraging is an effective strategy in financial planning. It refers to using borrowed funds or borrowed money to increase the potential return on an investment. This means that by leveraging, you can invest more money than you will be able to do with your own funds alone. For example, if you have $10,000 in savings, you could invest it in a rental property with a 20% down payment, giving you a total investment of $50,000. By leveraging, you can increase your return on investment without having to save all the funds yourself. Let's talk about the benefits of leveraging in financial planning. There are many benefits to leveraging in financial planning. Firstly, it allows you to invest more money and increase your potential return on investment. That's your ROI. Secondly, leveraging can help you diversify your portfolio, which reduces the risk. Finally, leveraging can help you reach your financial goals faster than if you were to rely solely on your own savings alone. In conclusion, financial planning is a critical aspect of managing your finances, and leveraging is an effective strategy that can help you reach your financial goals faster with more certainty. Remember to always consult with a financial advisor before making any financial decision, and to consider your own personal circumstances and goals. Thank you for watching, and I hope this video has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hi everyone, and welcome to this video on emergency funds and financial planning in Canada. In this video, we'll be talking about the importance of having an emergency fund and how to create one for yourself. First, let's talk about why emergency funds are so important. Emergencies can happen to anyone, and when they do, you want to be prepared. Whether it's a medical emergency, a job loss, or an unexpected car repair, having an emergency fund can help you get through those tough times. Without an emergency fund, you may be forced to use credit cards, take out loans, or even drain your savings to cover unexpected expenses. So how do you create an emergency fund? You start by setting a goal for how much you want to save. A good rule of thumb is to have 3 to 6 months of your living expenses saved up. This way, if you experience a financial emergency, you'll have enough money to cover your bills and other necessary expenses for several months. Next, make a plan for how you will save for your emergency fund. It's important to make it a priority in your budget and to put away a portion of your income each month. Automating your savings is a great way to make sure you're consistently putting money away into your emergency fund. You can set up a separate savings account or even a high yield savings account to earn more interest on your money. It's also important to be mindful of how you use your emergency fund. Remember, this money is meant to cover unexpected expenses, so it's not meant to be used for things like vacation or shopping trips. If you need to dip into your emergency fund, make sure to replenish it as soon as possible. In conclusion, having an emergency fund is a key component of financial planning in Canada. By saving for unexpected expenses, you can protect yourself from financial stress and be better prepared for whatever life throws your way. Start by setting a goal, making a plan, and consistently putting money into your emergency fund. Remember, the more you save, the more peace of mind you have. Thank you for watching, and I hope this video has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe. if you haven't done so already, and I'll see you in the next video. Hi everyone, and welcome back to our channel. Today we're going to talk about a topic in financial planning, and that's investing. Financial planning is a critical part of managing your finances, and it's never too early or too late to start. Whether you are a recent graduate or just starting your first job, or you are approaching retirement, financial planning is an essential step in securing your financial future. In Canada, for example, there are many different investment options available, from stocks, bonds, mutual funds to real estate and more. The key is to find the right mix of investment that will help you achieve your financial goals. Whether you're buying your first home, you're saving for your child's education, or securing a comfortable retirement, one of the most popular forms of investment in Canada is the stock market. Investing in stocks can be a great way to build wealth over time, but it's important to remember that the stock market can also be volatile and there is always a risk involved. That's why it's important to have a solid financial plan in place. A financial planner can help you understand your financial goals and develop a strategy to achieve them. We can also help you navigate the complexities of the stock market and find the right investment for your portfolio. Another important aspect of financial planning is insurance. In Canada, there are many types of insurance, from life insurance to disability insurance, and it's important to have the right coverage to protect yourself and your family in case of an emergency. A financial planner can help you understand the different types of insurance and find the right coverage for your specific need and budget. In conclusion, financial planning is an essential part of managing your finances in Canada. Whether you are just starting out or approaching retirement, a solid financial plan can help you achieve your financial goal and secure your financial future. Thank you for watching, and I hope this video has been helpful in your financial planning journey. Don't forget to like, comment, and subscribe if you haven't done so already, and I'll see you in the next video. Hello everyone, and welcome to today's video. Today we're going to talk about one of the most important aspects of managing your finances in Canada, and that's financial planning. Whether you're just starting out in your career, approaching retirement, or somewhere in between, financial planning is crucial to your financial well-being. One of the key components of a successful financial plan is a guaranteed investment certificate, popularly called the GIC. A GIC is a type of investment product offered by banks and other financial institutions in Canada. It offers a guaranteed rate of return on your investment, which means you can be confident that you will receive a set amount of interest when your investment matures. If you're new to financial planning or just looking to diversify your portfolio, a GIC is a great place to start. It's a low-risk investment option that offers a reliable, stable return on your money. While there are other investment options available that offers higher returns, they also come with a higher level of risk. With a GIC, you can be sure that your investment is protected and that your money is safe. Setting up a GIC is simple and easy, and you can do it right from the comfort of your own home. Many financial institutions offer online banking options that make investing in a GIC quick and convenient. When it comes to financial planning, the most important thing is to start early. The earlier you start, the more time for your money to grow and the more secure your financial future will be. And a GIC is a great way to start building a strong foundation for a financial future. I hope this video has given you a better understanding on the importance of financial planning and how a GIC can play a role in achieving your financial goals. Thank you for watching. Until we'll see the next video, Happy planning. Hello and welcome to our channel where we discuss everything related to financial planning in Canada. Today we'll be talking about one of the most important financial tools for Canadians. That is the Registered Retirement Savings Plan, popularly called the RRSP. Now, what is RRSP? A RRSP is a financial plan registered with the Canadian government that is designed to help you save for your retirement. With a RRSP, you can set aside money pre-tax, which can help lower your taxable income and potentially save you money on taxes in the short term. Why is RRSP so important? RRSP is crucial for anyone who wants to plan for their retirement and ensure they have enough savings to support themselves in their golden years. With an RRSP, you can take advantage of the tax benefit and grow your savings at a faster rate, which will help you reach your retirement goals faster. How does an RRSP work, you may ask? To set up an RRSP, you first need to find a financial institution that offers RRSP account. You can then make contributions to your RRSP account and receive a tax deductions for your contributions. The money you contribute goes tax-free until you withdraw it in retirement, at which point it will be taxed as an income. How much can you contribute to RRSP? The amount you can contribute to your RRSP depends on your income and the amount of unused RRSP contribution room you may have. You can find this information on the last notice of assessment from the Canada Revenue Agency. What are the deadlines for RRSP contribution? The deadline for RRSP contribution is typically the end of the tax year, which is by March 31st. However, you can still make contributions up until 60 days after the end of the tax year and still receive a tax deduction on your previous tax years. In conclusion, RRSP is a powerful tool for anyone looking to save for their retirement. By taking advantage of the tax benefit and contributing to your RRSP regularly, you can ensure a comfortable and a secure retirement. I hope this video has been helpful in understanding RRSPs and how they can benefit your financial future. Thank you for watching. If you have any questions or comments, please leave them below. Don't forget to like, subscribe for more financial planning tips and advice. Take care and see you in the next video. Hello and welcome to today's episode of the Financial Planning Education Show. In this episode, we'll be talking about tax-free savings account, popularly called the TFSA, and how they can help Canadians achieve their financial goal. So let's start by defining what a TFSA is. A TFSA is a savings account that is tax-free, which means that the money you save in the TFSA can grow tax-free and you won't be taxed on the money you withdraw from it. This is different from a regular savings account, where you pay taxes on the interest you earn. The great thing about TFSAs is that they are flexible, which means you can use them for any purpose you want. Whether it be savings for a big purchase like a house or a car, or an emergency savings, you can also use your TFSA to save for your retirement, as the money you save in the TFSA can grow tax-free. TFSAs also have contribution limits, which means that there is a limit to the amount of money that you can save in a TFSA account each year. The contribution limit for 2023 is $6,500. It's important to keep track of your contribution limit so that you don't over-contribute and face penalties. Now, if you over-contribute, the penalties will be a percentage of the increase that you've actually over-contributed. TFSAs are a great tool for financial planning in Canada, as they provide a tax-free way to save and grow your money. When you're making the budget and planning for your finances, it's important to consider how you can use a TFSA to help you reach your financial goals. And that's it for this section. I hope you found this information helpful and informative. If you have any questions or you would like more information on TFSAs, feel free to reach out to me. Thank you for watching, and don't forget to like, comment, and subscribe if you haven't done so already. I'll see you in the next video.